Hello and welcome to Pensions in 10 with me, David Brooks, and my colleague, Sadhbh Lynch. This week, we look at Torsten Bell's speech at the PLSA. Sadhbh talks us through US equities, and we look at the latest news on IHT.
Okay, so do you want to lead us through Torsten Bell's speech at the PLSA?
Yeah, sure. So these are always useful touch points with the government when they do a speech at a big conference. So Torsten Bell was up at the PLSA conference in Edinburgh, their investment conference, a 3-day pension extravaganza, if you can imagine such a thing. And he talked through really what's on the government's agenda for the next few years. I think really it was a very interesting speech, a lot in there. Regular viewers of Pensions in 10 or regular readers of the Pensions Press may not be completely surprised with all the topics in there. So he summarises again about the government's belief that DC schemes, there should be fewer of them, they should be larger, and that will create better pension schemes. And he's talking about a pension schemes bill and an investment review, which is the things they've been consulting on for the last sort of 6-7 months or so, looking at DB surpluses. So that got mentioned again about the ability to repay those to employers for ongoing schemes. So expecting something more on that to come through in the pension schemes bill. The LGPS pooling will be completed by March 2026. I've not been keeping a close eye on that, but that sounds extremely optimistic, but maybe he's right. More legislation for the super funds regime. He was hinting at, again, reviewing pension scheme rules to allow them to top up, or suggesting they should top up pre-97 increases where they've been fixed at zero over the last few years. And I think it's just more of the same. So we're going to get a pension schemes bill before the summer recess. And we already know there's going to be a few things in there around value for members. So he covered some of that. We also know that's going to cover some of the things around DC decumulation. But I suspect we're going to get a few more of these other ideas shoved in there as well. You know, this ongoing mission to sort of a pseudo nationalisation of the DC pension scheme system. And I suppose it does come on the back of some figures that the regulator did a few weeks ago where they were showing that the DC landscape is shrinking, and basically the government is keeping their foot on the accelerator to help that move through. I've managed to say all of that without mentioning the big topic that they actually want to talk about the most, which is UK productive finance or UK private markets, or there's about 13 different ways of describing this. And so that is still the thread running through this. So all this sort of pensions revolution we're going through with the way that surpluses are used, where the DC schemes invest for their members, is all predicated on the fact that the government want pension fund assets to be used to prop up government projects and infrastructure projects. And one of the big things that I've been thinking they should do is say more about what those investment opportunities are going to be. And so, Sadhbh, I think you've been looking at some of the hints that were in there in the speech about what they're going to do to make trustees feel that's an attractive investment.
Yeah, so I think at the moment they were saying that around 2% of the assets are invested in private markets, so private equity 2% and then infrastructure 2%, but they want this to go up to about 5% in either of them. So quite a large increase, over double for both of them. They're hoping that it delivers some returns to savers, although we're worried about the upside being too much dissimilar from what the current assets that they're invested in are, and hopefully also contribute to economic growth, which will obviously be good for everyone in the pension schemes. If there's economic growth, that will give them a better world to retire into. So kind of a similar strand to what you were speaking about with Andy last week. And I had to think about what the benefits are for DC and DB pension schemes, some of the threads running through that article. So for DC schemes, it's really good because it can offer a lot of diversification in comparison to a lot of the markets that they're usually invested in, so those public markets. But the issue is a lot of the private market funds have very high fees, and then also the underlying firms that they're invested in within these markets can be lacking a lot of transparency. So it's quite hard to get a flavour of what's actually included in some of these funds, which I think worries a lot of investors. So that's on the DC side. And then the DB side, as over the past few years, funding levels have improved quite significantly. There's been a move away from private markets because they can often be quite illiquid. So it's quite hard if a scheme wants to go to buyout to continue investing in these funds, because if they want to go to buyout, they're going to have to remove them. So there's definitely been a move away from private markets on the DB side. But I think it was interesting speaking about DB surpluses during this article. So If the scheme does want to run on, then I think there is probably an opportunity to invest in private markets there. But the actual amount of investment that will be for such a small proportion of schemes doesn't really make too much sense overall. Shouldn't be too much money, but interesting opportunities for both DB and DC. But yeah, I guess we'll see where it goes in the future.
Yeah, I think one of the things we've been talking about is if you build it, they will come. And so the government have been talking in this speech about their 10-year infrastructure strategy and building these opportunities which make it interesting for trustees to invest because up until now probably the opportunities have been few and far between, and that is a big part of the puzzle. Things like they're looking at swifter, is that a word? More swift permissions for infrastructure projects, so like solar farms, reservoirs. So that makes things more interesting. There's going to be a bill around that as well. So I think there's a lot of skepticism within the industry, and Sadhbh, you've been summing that up just a second ago. Really, there's a lot of skepticism around the use of these assets, either DB schemes which are doing something else with their assets, or DC, they're more worried about their member outcomes. If these opportunities come through and look attractive enough, then perhaps they will get the investment and they will get that money from the pension schemes. We'll have to wait and see. Okay, Sadhbh, so we're hearing a lot of noise in the last few weeks around US equities and their slide away. What have you been seeing, or what do you think trustees should be thinking about, and what does this mean for pension savers more generally?
Yeah, so there's been a lot of US market data in the news, especially since Trump came in. Obviously, that's had quite a lot of volatility in equity markets. So for context, the S&P, so the main US stock market, has fallen in the last month by 8%. So it's quite significant, especially as over the past few years, we've seen a period of US exceptionalism, or stocks have outperformed what we actually thought they were going to do on an expected basis. So why is this happening? So Trump has caused a lot of volatility. He's threatening potential tariffs for different countries, so that can have implications on US businesses and then also other economies as well. And then also, since he's been in power, the economic growth forecast for the US has also slipped. So that also has an impact on US markets because they don't think the economy is going to grow as much. So the outlooks for those US companies isn't as strong as it once was. So as I was saying previous to this, there's definitely been a strong period of US exceptionalism. So US stocks are now massive in comparison to the global market. So every global equities index is very heavily weighted towards that US market because they have the biggest companies in the world. So it naturally takes up a large proportion of those indices and funds. So now, because of these changes in the US market and the fall in the S&P, there's a shift away from investing in US markets and towards more European markets that I'm seeing a lot of managers are doing. So in talks with different investment managers, and why are European stocks good? So they tend to be a lot more stable and at the moment a lot less volatile than the stocks that we're seeing in the US. So it's good for trustees to just have an understanding of some of the diversification benefits, and then also that there is an alternative to the US stock market. We're definitely seeing a push towards the European counterpart. So I think a lot of people are reassessing their investment strategies. So especially this is to do with managers. They'll naturally be shifting more towards those US stocks, sorry, the European stocks, not the US stocks. And I think it's just something good for trustees to keep in mind in order to mitigate some of these risks that might be happening from the US and focus on some more stable market outcomes that we're seeing in Europe today.
Thank you.
So Dave, do you have an update on the inheritance tax issue?
Sort of, yeah. So Torsten's speech was one thing, we talked on that, but he was also answering questions to the audience at the PLSA, and in one of them he did note that they were continuing with their plans around inheritance tax. So this is effectively bringing virtually all discretionary lump sums paid from a pension scheme on death to the next of kin or the family in the realms of inheritance tax. So they're not going to change tack, so he says. I mean, we kind of feared this because the consultation itself was very on the technicalities of the policy rather than the actual policy itself, even though I think every single response to the consultation had a preface or a executive summary that, like ours, that went on about all the bad things that this could bring. So it feels like the government are just going to press on regardless. So this is potentially bad news if you think this is going to be tricky for members. And there are some trickier bits to it. I think in general the policy is not a terrible idea, but there are some trickier bits to it, bringing some benefits that people don't have any control of, things like DB, 5-year guarantees, and death and service lump sums, which aren't wealth management. They are just other features of the plan they're in, or good planning for if you die while you're of working age. And so, but it doesn't look like there's a hint that that's going to be changed. I do hope Torsten hears this. I do hope he thinks again, but it looks like we're on this track to all pension lump sums on death being subject to inheritance tax.
Okay, so thanks everyone for listening. I won't be joining next week, but you'll have Chris from our Smart Insure team to keep David company. Thanks.